Most people think compounding is a slow bank account crawl, but that mistake is costing them millions. In reality, wealth building is like a 7-level video game where the strategies that got you to level 2 will actually sabotage you by level 5. I am breaking down the exact math to help you hit the crossover point where your investments finally pay for your entire life. The standard view of compound interest is a dangerous oversimplification that essentially treats wealth building as a static, linear crawl. This fundamental misunderstanding does more than just slow people down. It is a systemic error that quietly drains millions of dollars from an individual's potential net worth over a lifetime. To truly harness the power of money, one must recognize that compounding exists across 7 distinct, evolutionary levels. Each of these stages operates on a different set of mathematical rules, and the path to retirement, whether it ends in being broke, merely comfortable, or genuinely wealthy, depends entirely on mastering these shifts. The most treacherous trap lies in the fact that strategies which provide a solid foundation at level 2 can become active liabilities by the time a person reaches level 5. This is why a vast majority of people find themselves hitting a wall at level 3 or 4, spending decades in a state of financial stagnation without ever identifying the friction. The urgency of this situation is underscored by a sobering 2024 study from the Federal Reserve, which reveals a looming crisis for those nearing the end of their careers. The median retirement account balance for Americans aged 55 to 64 stands at a mere $185,000. While a 6-figure sum might look substantial on a bank statement, the math behind it is brutal. When applying the standard 4% rule for sustainable withdrawals, that entire life's work generates only about $7,400 per year. That breaks down to a staggering $616 per month. It is impossible to maintain even a basic standard of living on such a pittance, yet this is the reality for the median household. Navigating this landscape is much like trying to pilot a high-performance aircraft with the manual for a bicycle. You cannot expect to reach the stratosphere if you refuse to change gears. This journey begins at level 1, often called the awareness stage. Here, the concept of compounding is known but entirely unutilized. Most people at this stage keep their capital parked in standard checking accounts earning a negligible 0.01% interest. This is a recipe for silent financial decay. With the 2024 average inflation rate hovering around 3.1%, a stagnant $10,000 balance effectively evaporates at a rate of $310 in purchasing power every single year. Without moving beyond this passive state, the very money meant for security is slowly being consumed by the economy itself. The true danger of inactivity becomes undeniable when looking at a 10-year horizon. That same $10,000, left to wither in a standard account, will eventually retain only $7,374 in actual purchasing power. This represents a loss of over $2,600 in real value, effectively vanished because of a refusal to act. It is a stark reminder that time is a finite asset currently being incinerated. Because of the exponential nature of compounding, every month spent on the sidelines incurs a higher cost than the one preceding it. Consider the concrete mathematical reality of this delay. An individual who starts at age 25, investing $200 per month with an average 10% annual return, is on track to amass approximately $1.4 million by age 65. However, should that same person wait just 5 years to begin at age 30, that $200 monthly contribution results in a final balance of only about $880,000. This is not a clerical error. A mere 5-year hesitation results in a loss of $520,000. Waiting over $500,000 away is the steepest price one can pay for procrastination. Escaping this trap requires a few immediate, tactical maneuvers. The first is moving emergency funds into a high-yield savings account. While the current 4% to 5% interest rates offered by these accounts are not a shortcut to wealth, they are infinitely superior to the 0.01% found in traditional accounts. The second step is opening a brokerage account, or maximizing an employer 401k. At this stage, the objective is not to demonstrate superior intelligence or to gamble on individual stocks, but simply to begin. Placing funds into low-cost index funds that track the S&P 500, such as Vanguard's VOO, Fidelity's FXAIX, or Schwab's SWPPX, is the most effective way to start. The transition to Level 2, the foundation stage, is defined by this shift from theoretical knowledge to decisive action. Success at this new level is measured by the transition of wealth building into a structural habit. It is like pouring the concrete for a skyscraper. The integrity of everything that follows depends on consistency and automation. Sporadic contributions, such as depositing $500 once and then disappearing for 6 months, fail to create the necessary momentum. Research from Vanguard highlights the power of removing the human element, showing that investors who automate their contributions see account balances that are 60% higher on average than those who attempt to invest manually. Under a consistent 10% average annual return, the first year of this discipline yields approximately $6,300. While this figure may not appear life-changing initially, the trajectory quickly becomes compelling as the years accumulate. By the 5-year mark, the balance reaches about $38,600. Curiously, the data suggests a dip to roughly $12,000 by year 10, though the momentum resumes aggressively thereafter, with the 20-year milestone hitting $381,000. By year 30, that steady $500 monthly commitment transforms into a substantial $1.1 million. However, a critical strategic error often occurs at this stage. Investors tend to obsess over marginal gains in investment returns while neglecting the far more potent lever of their own contribution rate. To put this in perspective, consider the math of the extra mile. If the monthly investment is raised from $500 to $750 at that same 10% return, the final 30-year total jumps to $1.65 million. That additional $250 a month effectively buys an extra $550,000 in terminal wealth. Compare this to someone who sticks with a $500 contribution but manages to overperform the market to achieve a 12% return. While they still end up with a respectable $1.47 million, the increased contribution clearly outperformed the increased return by a margin of $180,000. At this phase of the journey, boosting the amount of capital entering the system is statistically more effective than chasing volatile alpha. The action plan for this stage is built on surgical precision and psychological barriers. First, automation is non-negotiable. By scheduling transfers for the exact day a paycheck clears, the capital is protected from the temptation of lifestyle creep. It is a method of financial invisibility. Money that never enters the visual field of a checking account cannot be impulsively spent. Second, investors should implement an annual contribution increase of 1%. Moving from 10% to 11% is a shift so subtle it rarely impacts daily comfort, yet it yields massive dividends over decades. Third, maintaining a 3 to 6 month emergency fund in a high-yield savings account is essential for defense. This cash cushion ensures that a market downturn never forces the liquidation of long-term assets at a loss. For those seeking to accelerate this timeline, exploring digital leverage through platforms like YouTube remains a premier opportunity of the current decade, supported by resources for those starting from zero. This brings us to Level 3, the optimization stage. At this stage, the focus shifts toward the precision of tax efficiency, the nuances of asset allocation, and the relentless maximization of every dollar's utility. Most people in this bracket are consistently investing between 15% and 25% of their income, having amassed a net worth ranging from $100,000 to $500,000. While these figures suggest a position of strength, this level is deceptively dangerous. Because you are performing so much better than the average person, it is easy to succumb to complacency, unaware that you are potentially underperforming your own true potential. One of the most significant ways investors hinder their growth is by ignoring tax optimization, a mistake that results in leaving massive amounts of money on the table. To avoid this, one must master the 3 primary pillars of investment accounts: traditional tax-deferred accounts like a 401k or IRA, Roth accounts where taxes are settled upfront, and taxable brokerage accounts. The way each of these compounds is fundamentally dictated by their tax treatment. Consider the math over a 30-year horizon with a $10,000 annual investment. In a standard taxable account, where dividends are hit with a 15% tax and you sit in a 24% regular income bracket, your final balance would settle around $1.3 million. By contrast, a traditional 401k allows that same capital to grow tax-free to $1.81 million. Even after paying an assumed 22% tax at withdrawal, you net roughly $1.4 million. The Roth IRA, however, is the gold standard. It also grows to $1.81 million, but that entire sum is yours to keep, tax-free. The delta between a taxable account and a Roth IRA is over $500,000, despite identical contributions and market returns. Realizing the full benefit of this requires a strategy of tax diversification, holding a balance across all three account types. This creates a psychological and financial control panel for your future, allowing you to fill up lower tax brackets with traditional distributions while pulling from a Roth to avoid triggering higher taxes on Social Security benefits. Mastering this coordination can save hundreds of thousands of dollars over a lifetime. At this stage, the mission shifts toward an aggressive pursuit of full utilization across all tax-advantaged vehicles. While prior milestones focused on the act of saving, the current objective is to secure every possible shelter from the eroding effects of taxation. For the 2026 tax year, this means pushing toward the updated 401k contribution limit of $24,500 for those under age 50, or a total of $32,500 for individuals aged 50 and older. Similarly, the capacity for individual retirement accounts has expanded. The 2026 limit stands at $7,500, with a catch-up provision allowing $8,600 for those over 50. If one has access to a health savings account, it must be maxed out with the same intensity. Often described as the single most powerful retirement tool in existence, the HSA offers a triple tax advantage. Contributions reduce taxable income, the internal growth is shielded from taxes, and withdrawals remain entirely tax-free when used for medical expenses. Once the accounts are filled, the focus must turn to the architecture of the portfolio itself. Asset allocation is the primary engine of long-term stability, dictating how capital is distributed across stocks, bonds, and real estate. While younger investors can afford the volatility of a 90% stock and 10% bond split, time necessitates a gradual migration toward stability. A modernized rule of thumb suggests subtracting your age from 120 to determine your ideal stock percentage, a necessary adjustment given that we are living longer while bond yields have become less reliable. By age 30, this suggests a 90% equity position, tapering to 70% by age 50. As these optimizations take hold, you enter level 4, the acceleration stage. This is the moment when the math of wealth building finally begins to feel visceral. With a net worth typically between $500,000 and $2 million and an investment rate of 25% to 40%, you reach a profound crossover point. Consider a $500,000 portfolio growing at 10%. That single year produces a $50,000 gain, a sum that likely rivals or exceeds the $30,000 you contribute through active labor. It is the realization that you are no longer merely hoarding cash, but have successfully engineered a self-sustaining financial engine. However, this success brings a new, subtle predator: lifestyle inflation. As earnings dwarf those of earlier years, the urge to expand one's standard of living can threaten to stall the very momentum that made this acceleration possible. With the influx of capital from promotions, strategic job changes, or thriving side businesses, the urge to aggressively upgrade one's lifestyle becomes nearly magnetic. It starts with the allure of a sprawling house, a precision-engineered car, or increasingly lavish vacations. While enjoying the fruits of labor is not inherently wrong, one must recognize that every dollar redirected toward lifestyle maintenance is a dollar permanently removed from the engine of compounding. To ignore this trade-off is to ignore the true cost of consumption. Consider the choice between a $40,000 vehicle and a $60,000 model. That $20,000 price gap, if instead captured and invested at a 10% annual return, would balloon into $134,000 over 20 years. Few people perform this calculation, yet it is essential to decide if a slightly nicer interior is truly worth a six-figure sacrifice in future wealth. Navigating Level 4 requires a sharp focus on the crossover point, the pivotal moment when your investment returns finally eclipse your living expenses. Using the 4% rule as a guide, if your annual spending totals $60,000, you have reached financial independence once you have $1.5 million invested. At this threshold, your portfolio becomes a self-sustaining ecosystem that generates your entire livelihood. Reaching this milestone marks the transition into a life where work is a choice rather than a necessity. To secure this state, you must first define your personal crossover number by dividing your annual expenses by 0.04. If you spend $80,000 per year, your target is $2 million. If you spend $100,000, you require $2.5 million. Once your target is set, use a compound interest calculator to map your trajectory based on current savings, monthly contributions, and expected returns. Accelerating this timeline involves a dual-track strategy of increasing income through side ventures while ruthlessly cutting expenses that fail to bring genuine joy. Every incremental dollar invested acts like a tailwind, pushing your date of independence closer. Successfully crossing this finish line leads to Level 5, the multiplication stage. In this bracket, with a net worth between $2 million and $10 million, the focus transcends traditional personal finance. You are no longer just compounding currency, you are compounding high-level opportunities, strategic connections, and sophisticated leverage. This is where the truly fascinating mechanics of wealth begin to unfold. This significant accumulation of capital unlocks an elite investment universe that remains invisible to the general public. At this stage, you move beyond public markets into high-minimum vehicles like private equity, angel investing, real estate syndications, and venture capital funds. These opportunities typically demand entry stakes ranging from $50,000 to $250,000 or more. While the risk profile increases, the reward potential is far superior. Data from Cambridge Associates highlights this gap, showing that top quartile private equity funds have averaged annual returns of approximately 16% over the last 2 decades, significantly outperforming the 10% average of the S&P 500. However, the most potent asset at this level is the compounding of relationships. By moving in circles with other successful entrepreneurs and high-performing investors, you cultivate information asymmetry. This is a state where you possess specialized knowledge and early deal flow that hasn't yet reached the broader market. Much like a high-speed data connection compared to a standard signal, this specialized network allows you to act on opportunities before they are picked clean by the public. This intellectual and social capital compounds with the same relentless mechanical power as your bank balance. The mathematical impact of even a slight shift in allocation is staggering. Consider a $3 million portfolio. A standard approach of 100% index funds at a 10% return yields $300,000 annually. But if you pivot just $500,000 into a private real estate deal returning 18%, your total annual return climbs to $340,000, or an 11.3% overall yield. Over 20 years, that minor 1.3% increase creates a final balance of $24.1 million instead of $20.7 million. That single decision to diversify a fraction of your wealth results in an extra $3.4 million. This is why the focus must shift to asymmetric opportunities, scenarios like angel investing where the downside is capped, but a single unicorn return of 100 times can turn a series of $25,000 losses into a $2.05 million net profit on a $250,000 total stake. Reaching an 8-fold return on capital is a remarkable achievement, yet such aggressive maneuvers are only feasible for those whose financial security is robust enough to withstand a $225,000 loss without flinching. At this stage of the journey, the complexity of your holdings necessitates a shift toward elite professional management. Relying on a fee-only financial advisor, a CPA who specializes in high-net-worth portfolios, and an expert estate planning attorney is no longer a luxury, it is a defensive requirement. While these professionals require a significant investment in fees, their value is realized through sophisticated tax mitigation, the avoidance of catastrophic errors, and the structural integrity of your long-term plan. This transition naturally leads to level 6, the legacy stage. Here, net worth typically exceeds $10 million, crossing a threshold where you possess more capital than could reasonably be spent in a single lifetime. The mechanics of compound interest have fulfilled their original purpose, shifting your focus from the accumulation of money to the compounding of impact. The primary challenge becomes the strategic architecture of the future, determining how to position children, grandchildren, and favored causes for enduring success. One must solve the riddle of how wealth can continue its trajectory long after its creator has departed. This is the era of trusts, private foundations, and the most advanced forms of estate engineering. The mathematics of generational wealth are staggering. Consider a principal of $15 million with an annual spend of $300,000. This represents a mere 2% drawdown rate. If that capital earns a 7% real return after inflation, the portfolio actually grows by 5% every year even while funding a lavish lifestyle. Over 20 years, the balance swells to approximately $39 million. Over 40 years, it surpasses $100 million. At this altitude, wealth behaves like a self-governing ecosystem, expanding into a multigenerational legacy without requiring a single additional dollar of contribution. However, a stark reality remains. Data from UBS suggests that success is not guaranteed by the numbers alone, but by clear family governance and the education of heirs. Without a concerted effort to align wealth with core values through philanthropy and impact investing, the risk of failure is high. The catastrophic failure of most multi-generational wealth is rooted in a vacuum of financial education, work ethic, and a defined sense of purpose within the next generation. At this elevated level, the primary mission evolves from compounding capital to compounding wisdom. It requires a deliberate curriculum for heirs, teaching them the actual mechanics of money, involving them in high-level investment decisions, and training them to evaluate complex opportunities. True mastery is only gained when heirs are granted real responsibility over real capital. A family must define what its money exists to do, how it should be used, and the values that should guide its deployment through a formal mission statement. Utilizing a donor-advised fund or a private foundation serves as a practical classroom for these values. For instance, a $1 million donation to a donor-advised fund secures an immediate tax deduction while allowing the capital to grow tax-free. As the family decides together where to distribute these funds to charities over many years, they learn the art of impact alongside the benefits of strategic tax planning. Beyond the legacy of a single family lies level 7, the infinite stage. This is the final form of compounding, a self-sustaining state where wealth grows faster than any possible rate of consumption. In this bracket, net worth is measured in hundreds of millions or billions, but the true hallmark is the creation of systems that compound indefinitely. Consider the endowment model, exemplified by Yale University. With an endowment exceeding $40 billion, it has averaged annual returns of 10.9% over the past 20 years. By distributing only 5.25% annually to fund operations, the principal continues to grow in perpetuity while simultaneously funding the institution forever. This is the pinnacle of financial engineering. It often involves business equity and intellectual property that generate massive passive income streams. J.K. Rowling provides a perfect example of this intellectual property compounding, where books written decades ago still produce millions in royalties every single year. When an investor can transition from simple capital accumulation to the simultaneous compounding of expertise, deep relationships, and capital, they unlock a multidimensional growth engine that functions across various fields. This marks the entry into the infinite stage, the ultimate form of compounding where one begins to fund culture, ideas, and systems designed to survive their own lifespan. At this level, wealth evolves into a social ripple effect. Instead of merely making more money, the capital flows into world-changing technologies, scholarship programs, the establishment of enduring institutions, and the funding of critical research. The wealth is no longer a personal scorecard, it is a mechanism of societal influence. This systemic approach is best illustrated by the institutional endowment model. Take the Yale University Endowment, which holds a principal of over $40 billion. Over the last 20 years, it has maintained a staggering 10.9% average annual return. By distributing approximately 5.25% each year to fund university operations, the remaining 5.65% ensures the principal grows in perpetuity. This allows the institution to fund its mission forever while the base capital remains untouched and expanding. Intellectual property acts in a similar fashion. Consider how the Harry Potter series continues to generate millions in royalties decades after its creation. This is the power of a value printing press that never stops. One could sell a software company for $500 million and reinvest that capital as an angel investor into 50 other startups, scaling their original expertise across an entire ecosystem of innovation. Crucially, this level of thinking is not reserved for billionaires. A family can establish its own mini-endowment, or an individual can build software and systems that provide value long after they have moved on. Mentorship serves as a way to compound wisdom, multiplying knowledge through the success of others. The core of this journey is understanding that compounding requires different strategies at each milestone. While levels 1 and 2 are about automation and building consistency, level 3 demands optimization for tax efficiency. Level 4 is the race toward the crossover point where investment income exceeds expenses, while level 5 leverages that stability for asymmetric opportunities with capped downsides and massive upsides. Level 6 focuses on the generational transfer of values, and level 7 builds the infinite systems. Honesty regarding one's current position is vital, as most find themselves at level 1 or 2. There is no shame in this starting point, provided there is a clear path forward. In 2026, one of the premier vehicles for this type of scaling is the faceless YouTube model, a golden opportunity for monetization and building digital intellectual property. By leveraging strategies from successful channels, it is possible to scale a media empire without ever being on camera. Time remains the most relentless force in this equation, meaning the ideal moment to advance was yesterday, but the second best is the present. Note that this exploration is purely for educational purposes and results depend entirely on individual actions. The path to an infinite legacy is open to anyone willing to evolve their strategy alongside their capital.